Hi everyone, this is Gokul. Welcome to another episode of Logic and Lace. People, every time foreign investors pull money out of India, panic hits the Dalal Street. Headlines scream FIIs sell off.
Overseas investors have pulled out a net 1,14,856 crores from the Indian markets in the current year so far. Foreign portfolio investors have sold domestic equities worth 48,261 crores, and this is the sixth straight month that foreign institutional investors have withdrawn from their positions in the Indian equity market. A trend.
And the next line comes, DIIs are buying, they will save the market.
FIIs and FPIs may come and go, but today Indian retail investors have proven that even if they come and go, any shock that may come is now taken care of because of the shock absorbing capacity.
Sounds comforting, doesn't it? But have you ever noticed what actually happens? The market still corrects. So today, let's peel back the layers to understand who really drives our stock market, the FIIs or the DIIs. And as retail investors, what should we learn from it? Before we get into data, just know who these FIIs and DIIs are. FIIs are the foreign institutional investors like global funds like hedge funds, pension funds, and the sovereign funds that invest in Indian equities for the returns. While DIIs are the domestic investors, mostly mutual funds, insurance companies, and the banks that invest local money, mostly yours and mine, through SIPs and the insurance premium. Both buy and sell in the same market, but their motive, size, speed are completely different, and that difference decides how the market moves. Let's not talk theory. Let's look at what really happened in the last few years. For this people, we studied four major phases where FIIs and the DIIs moved in opposite direction and how the market reacted to that. Phase 1, September 2022 to February 2023. In this period, FIIs sold around 63,000 crore while DII bought 94,000 crores. Even though domestic investors bought more, the market still fell 8.5%. Next, between August and October 2023, FII sold around roughly 76,000 crore and DIIs bought 70,000 crore. Despite this near balance, the market still slipped 3.5%. Then came the big one, October 2024 to February 2025. FIIs withdrew a massive 3.23 lakh crore while DIIs bought slightly more at 3.37 lakh crore. Yet the market crashed nearly 14%, steepest in the recent years. And finally, from July to September 2025, FII sold about 1.29 lakh crore while DIIs bought around 2.21 lakh crore. This time the market corrected 4.3%, smaller but still a drop. Now if you noticed, in all these four timelines, one thing repeats. FIIs sell, DIIs buys, yet the market still corrects. Clearly, it's not just about who buys more. It's about who controls the flow of sentiment and the liquidity. So let's decode why these markets react so sharply to FII moves. There are four key reasons why FIIs have an outsized influence on the Indian market. And understanding this will change the way you see every headline. First thing is the global liquidity flows. FIIs moves money across countries. If the US raise interest rates and or if the global investors turn risk averse, they pull money out of emerging markets like India, even if India's fundamentals are strong. When they sell here, it's not about India being weak, it's about global money shifting elsewhere. The second thing is the currency pressure. When FIIs sell Indian assets, they convert rupees back to dollars. This weakens the rupee, and a weakened rupee make imports like oil, electronics costlier, pushing the inflation up. So foreign excess hit both stock prices and the currency stability at once. The third one is the market depth and speed. Even though domestic investors often buy as much or even more than foreign investors, their buying is spread out and steady through monthly SIP inflows and the value pricing. FIIs on the other hand sell in sharp bursts, offloading billions within days. This sudden exit hit the market immediately, long before DII can absorb the shock. And the fourth most important one is the sentiment and narratives. When FIIs sell, it creates the global ripple, media headlines, social media panic, and retail fear. These retail investors often assumes that FIIs know something and they start selling too. This chain reaction magnifies the fall. So what looks like an FII sell-off is often half fundamentals and half fear. So what should we as retail investors take away from all this? What should we do? First thing, don't do panic selling. When FII sells, markets often drop sharply, but that doesn't mean the fundamental collapsed overnight. It's usually a short-term sentiment reaction. Once the FI fear fades, DIIs, retail buyers, steps in prices recovering. Panic selling only ensures one thing, that you book losses while the smart ones buy at cheaper prices. The second one is watch the trend, not one-day data. You will often see headlines saying FI sold 5,000 crores today and people panic immediately. But institutional money moves in cycles. What matters is the net flow over the weeks or even the months. One bad day or even a bad week doesn't define the market's direction. Look for consistent inflows or outflows before making any big decisions. The third one is SIPs or your silent stabilizer. Every month, crores of rupees flows into mutual funds through retail SIPs. This money doesn't stop even when the markets fall. That's what gives DIIs their steady buying power, which in turn helps the market recovery. So by simply staying consistent with your SIPs, you are indirectly part of the force that balances the global volatility. The fourth one is understand the global cues. They drive the FIIs. When you see FIIs selling heavily, it's rarely because something wrong with India. It's usually because of what's happening globally. For example, if the US Fed raises the interest rates, American bonds become more attractive. So FIIs moves their money back to the US. And when the dollar index strengthens, their returns in rupees shrink. So they exit to protect profits. And during global tensions or recessions, investors everywhere become risk averse. So FIIs pull out from emerging markets like India. So instead of reacting to daily FII numbers, track global triggers, interest rates, dollar movements, and crude oil prices. That's where the story actually begins. Remember, FIIs follows global liquidity. DIIs follow Indian discipline. You can't control what FIIs do, but you can control how you react to that. So the next time you see a headline like FIIs selling to 20,000 crores, DIIs by 25,000 crores, don't just read the numbers. Ask yourself, what's the driving force between these moves? What's there beneath the surface? Because markets are not just about who's buying or selling. They are about why money moves. And that's it from my side today, guys. Thank you for watching. Subscribe to Logic and Layers and let's keep decoding the markets one layer at a time. Thank you, guys.